much awaited mineral resource estimate is out. The headline number is 109.2 million tonnes at 1.42% lithium.
Got some cross sections.
Oh, how good are they?
The reason I push back on doing a peer comp on an EV per lithium equivalent resource ton on this one is because let's take a look at the peer group. So I just think this is a bizarre peer group to choose, especially to show an EV per resource comp.
I mean, some of them are producing this year.
Yeah. When you look at the brokers out there covering it, there's an assumption that they're making which is most in doubt in terms of actually, and is a big value driver here, and that's time to production. This kind of thought process really evolved when we listened to Chris Allison's analyst call.
Deposits outside of Australia, you're sort of somewhere from 8 to 12 years before you can get them permitted and get them online in Australia.
G'day, Money Miners. Monday, 31st July, last day of quarterly reporting. And you know what tomorrow means, boys?
Name and shame.
Name and shame.
I'm looking forward to that one.
I love it.
There's been a few announcements rolled onto the ASX already, Matty. 850 I counted. And there's still a bunch of names. We're waiting for their quarterlies to come through. Not naming any. Sayona, I'm waiting.
100% naming some. AVZ's got through, eh?
Early.
We'll have to interrogate that one. It's just come out.
Good on you. Right, big one today. The headline is Patriot's Mineral Resources finally out. We're going to get right into that from the start, boys. Bit else on the calendar. Silver Lake down nearly 20% after their quarterly.
Yeah, off over 20% to start. Emerald came out with a neat little transaction late last week and quarterly today. What else have we got? We'll touch on Strandline.
You've gone deep into Strandline, Jade. Are you trying to get
I don't know what happened to me.
Has Trav had enough of mineral sands?
I thought I'd get up the curve on what's going on out there. And there was, what else have we got?
The Saudis, mate.
Saudis
Not
buying...
oil, but bloody mining.
Yep, a stake in VALE's base metals unit or subsidiary, which I find super fascinating. We'll touch on that one. Anything else, guys?
That's about it. Diggers next week. Here we are excited. Should we give away our calendar of where we're going to be for the money miners if they want to catch up?
I think we should, mate. We absolutely should.
Well, we've got Sunday night, got the Top Drill Sundowner, RFDS charity event, so pretty big event. So get along to that. Get in contact. I don't know if it's free invite or hit them up, but it's a good fundraiser. I think they're looking to raise about 150 grand for RFDS and stuff. So
beautiful work.
Good work, Top Drill. I'm playing golf Monday morning. Sure, and partners, boys. I'll sort that out for you. Canaccord dinner Monday night.
Yes. Yep. Yeah, that's exciting, mate. I think that's a big event, that one. That'll be very fun. And
then you boys are parking up shop and I'll be attending when I'm not socialising. Where's the location, Trav? You've done a great job sorting this out.
Thanks, mate. Being from Kalgoorlie helps sometimes, very rarely, but sometimes. We will be set up during sort of business hours of Diggers inside Benali's hotel there, which is one of the pubs / restaurants / cafes on the main street, Hannon Street there. So for the people who are leaving the event and going to go get themselves a coffee during the day or a beer, we'll be set up with the recording equipment. Come grab a beer with us or a coffee, and we'll be filming content throughout sort of business hours. So come along and have a chat. We'd love to hang out. And then outside of those commitments, if you've got events to invite us to, we'd love to come to them as well.
Very good. Can't bloody wait. What is it? Benali's. Is that how you pronounce it?
Benali's, yeah, Debo's it goes by.
Debo's is going to be the Money of Mine HQ for Diggers. Mostly Trav and JD will probably most likely be there. Who knows where I'll be.
But big thanks to Luciano who runs and owns Debo's in Kalgoorlie.
Good stuff. Righto, let's get into it, boys. This episode's like to thank our friends at Terra Capital, Langers and Bondi. Great partners of the show. We're due to get them on for another one, I reckon, soon. So I appreciate your support, Terra. Boys, let's get into it. Patriot. They're finally here. God, haven't we? That was sort of kickstarted Money of Mine, that.
Yeah. I think it was a second week, wasn't it? We talked about it.
Yeah, probably a lot of traction since then. Good learning curve for us, probably. But the much awaited mineral resource estimate is out. The headline number is 109.2 million tonnes at 1.42% lithium, at a 0.4% lithium cutoff. So it's finally out. They're sitting at around down 4.5%. I think they were down as far as 7%. So bit of action. Did have a bit of uptick on Friday. I think it was up
12 odd %.
Yeah. So it's come back down a bit. We're going to get right into it. So and there's definitely a lot of commentary on Twitter and everywhere.
And you had a look at how it sort of stacked up versus some of the West Australian.
Yeah, well, you could go over size and cut-off grade and everything, but look, Kathleen Valley, their main one at the end was 156 million tonne at 1.4%.
Yeah, not the Maiden for that one.
No, not their Maiden. And that was at 0.55% cut-off. Pilgangoora, they ended up getting 309 million tonne at 1.14. Wodgina, 236 million tonne at 1.19. So good grade. It's up at that, just surpassed Kathleen Valley's grade for the cut-off grade they use. If they drop the cut-off grade, the main grade goes down and the tonnes go up. So yeah, that's where it's sitting. So look, good result on paper, but look, it is down a bit, and we're going to delve into why the commentary thinks why it may have gone down.
Yeah.
And look, this is exciting. Oh, we've been waiting for it. How good is it?
Oh, it's very exciting, Matty. Very, very exciting. And there's a few things to talk about on this one. First one is we've got some cross sections.
Oh, how good are they? Love it.
I know. I'm keen to talk about them, but I'll save it for the mining guys and the geos because they're the real cartoon lovers, Matty.
There was I'm sure you're going to show the tweet later. Someone said, what was it? Here's some cross sections for you to.
No, hold it.
Oh, geez, I can't. I'm too excited to talk about it.
I'm excited too. Yeah, so we'll save it. We'll save it. So like, how does it stack? I'm keen to know how did the resource stack up versus the expectations in the market. So up on the screen for the YouTubers out there, we've got the table that was included in the short thesis report, which showed what all of the brokers and analysts were expecting. And in general, you can see it's underperformed on tonnage, but it's outperformed expectations on grade. It's a little bit strange because I think it probably on net beat the expectations of the analysts, but the stock is down. So we're kind of curious to dig into why that might be. And I think when you zoom out of the resource, which you're going to go into in a bit more depth, Matty, I think we can find ourselves getting really locked into the resource assumptions as the driver of value, but I actually think it's a different assumption the brokers are all making, which is the highest risk to potentially disappoint on the value that they're getting.
So by that, I'm assuming you mean, Trav, it was at that point where either the mineral and we've talked about this on previous episodes, either the mineral resource was going to confirm or potentially disappoint because it had such a high valuation and such a high attention to it. Mm-hmm. Is that sort of what your take of it is in this process?
I think it was going to be hard to surprise to the upside in a big way because the brokers were optimistic and the market had the data to there were a lot of people out there looking at this, right? So
did it surprise you? Where did it sit for you guys? We've got the broker reports, I guess, where we're getting our predictions from. What did you guys think of the resource estimate when you first saw it? First thoughts of the number?
High grade. That's the first thing I saw.
Yeah. And because what about you, JD?
Yeah. I think to what Trav just said, higher grade than perhaps slightly anticipated and slightly lower tonnage.
Because a lot of the commentary in the tables up there, a lot of it was around the low 1% that a lot like Canaccord and that were predicting. I think they were predicting about 1.1. And look, technically that is still there. They've just used a bit higher cut-off grade to get it to that 1.42
and then
the number they've reported.
The other thing that stands out straight away is that it's all inferred, which, it's not the most unusual for a maiden resource, but just another aspect that stood out straight away.
Yeah, we'll go into that a bit later. So
and before you pull apart the mining stuff, Matty, because you're the best person to talk about that. I'm
the only person.
Oh, we could try, but we won't sound smart. I'm keen to kind of talk about like when you look at the brokers out there covering it. I think there's an assumption that they're making, which is the one that I think is the most in doubt in terms of actually and is a big value driver here, and that's time to production, right? So if you look at the broker reports out there, the ones that I could get access to today, let's talk about the assumptions that they have for first production. Canaccord, 2030, Macquarie, 2028, Euros, 2029, Desjardins, 2029. And the reason I want to point to the date of first production as a big driver of value here is it's just because, like, think of the discount rate dynamic in a high interest rate environment, the opportunity or the time value of money that comes if things are delayed by a material number of years. And this kind of thought process really evolved when we listened to Chris Allison's analyst call for Min Resources just a few days ago.
He knows what he's talking about. I could nearly weight his opinion as a pretty good one, Mr. Ellison. Talk about a bloke that's been there and done it.
Yeah.
I listened to the whole thing on the weekend. It was ripping. Yeah. Awesome. Like, started with 10 and a bit grand himself and built MinRes. Like, it is his own cash, heart and soul that's been put into this business.
Yeah.
So when he says something, you do listen.
Absolutely. Yeah. And like you talk about a mining leader who has better alignment, just from a to invest alongside kind of dynamic. So yeah, I think you absolutely listen when he talks. I'm keen to just play a snippet when he's talking about the timelines it takes to develop new lithium mines. So let's have a listen to that now.
You don't just find a deposit and turn it on. If you're finding deposits outside of Australia, you're sort of somewhere from 8 to 12 years before you can get them permitted and get them online. In Australia, 3 to 4 years to get them permitted. Then when you go build the supply chain out, there's probably another 3 or 4 years. So bringing lithium into the market is expensive. Takes a long time. All of the approvals that are required from the TLOs, from the mines department, are getting harder and harder because it appears that half the people have disappeared off the planet, so it's just taking longer.
Very interesting. Very interesting. So overall, it's accelerated a lot more in Australia, but outside of Australia, he's claiming potentially 8 to 12 years.
8 to 12 years. So let's take that as one data point, 8 to 12 years, right? In PMET's, well, that's from discovery. So in PMET's case, the discovery hole was December 2021. 8 to 12 years, for a permit to get online puts that at between 2030 and 2034. Let's take a look at let's just take the low end of the broker estimates. The lowest one in that range, and they're all pretty close, but the lowest estimate is 2028. So there's a big difference between 2028 and 2034, which is the high end of Chris Allison's implied range. For example, right, if you just run an NPV at a 10% discount rate, the difference between being in production in 11 years' time versus in 5 years' time, which is the implied time to production from those two dates, it's nearly twice the difference to your NPV. So that's a big risk, and it matters a lot, right?
Well, then I guess if we want to narrow it down to today's announcement, this is the Maiden mineral resource estimate. So we'll fast forward a bit from initial discovery. So look, Liontown, their Maiden mineral resource was out in September 2018, and they're scheduled to start production starter next year. So look, that puts them at 5.5 years from Maiden mineral resource to first production. Pilgangoora, their Maiden mineral resource coming in August 2011. So I think that was by Altura. Then that was before Pilbara were the owner of the asset. So their first production was June 2018. So that was 6.5 years. Maiden mineral resource to first production. That was in a bit of a different lithium market to probably what Liontown's in. Liontown's really in the flavoured thematic at the moment. So look, that's an indication of Australia. So even 3 to 4 years that Mr. Ellison said is probably, that's everything going pretty bloody good.
And he had some comments on supply sort of lagging demand as well, didn't he?
He did. I think it was immediately after that statement he mentioned that for the next 5 to 7 years he was expecting the supply to lag demand. I'm not sure if the inference from that comment is that potentially after 7 years is there risk that supply exceeds demand. So my question is, what's a reasonable long-term lithium price assumption to use beyond 7 years from now?
Yeah, and I think his context was specifically having a go at the Goldman Sachs forecasts for the commodity price over the near to medium term, saying, you know, there is a clear supply lag, and him sort of by sort of inference saying that the free cash flow and everything was going to be higher in the medium term for mineral resources.
Right. So how we're gonna compare this to peer-to-peer comparisons? Like, God, you can use anything to favour your argument or agreement, whatever.
Yeah.
No, we did talk about the EV, but Trav, you're going to go in. They even put a table up of talking about EV to resource, but
first up, you need to find suitable peers, don't you, to do a peer comparison.
And you said this to me this morning, Matty. You're like, all right, so we're modelling it on EV reverse. What are we comparing it to? And I said, we shouldn't. There's no, it just doesn't make sense. There's a few reasons why, and I kind of pushed back a bit on that one. And you were keen to get out the spreadsheet. I know I could see it, mate. You wanted to get up some charts. But the reason I pushed back on doing a peer comp on an EV per lithium equivalent resource ton on this one is because let's take a look at the peer group. So Patriot put out in their investor presentation on page 29 today, they actually include a chart. On the chart, the y-axis is market cap. So don't let that inform what you think the EV per resource ton comp is, because that's actually the highlighted row I've got here, EV per resource ton. Now let's look at the companies that they are grouping together as developers, hard rock developers, they use with an asterisk. I just think this is a bizarre peer group to choose, especially to show an EV per resource comp. So there's a lot wrong with the chart, right? Including the inclusion of AVZ as its last traded price before it was put in a bloody suspension like 12 months ago. Let's put that aside, though.
Just make that 1 0.
Yeah.
That's possibly where it's going.
Oh, who knows? That aside, the issue I have with comparing EV per resource for developers is something I learned in my first month of resources banking. You can't comp an unfunded EV versus a funded EV and think there's any useful information in that analysis. Imagine a developer, right, that is very close to production. So the plant is built, mining's commenced. They are what we call fully funded, meaning that they had to raise funds to build the mine and they sunk that into CapEx. Raising those funds happened via debt and equity. Both of those mechanisms, i.e. raising debt or equity, increase the EV. So the EV goes up, right? Now think about a developer that's much more early stage. Their EV today does not capture any of the CapEx that needs to be spent in order to get into production. They are simply drilling out the resource. So to compare the two companies in any semi-scientific way, you need to add the expected unfunded CapEx to the EV of the earlier stage one.
Long and the short, you can't compare Liontown and Patriot because Liontown is just about to produce and they've sunk the CapEx and got permits and everything. So if you're going to compare Patriot to anyone, it'd be someone like an Azure or a Latin. Probably Latin Resources might be a good one. They've just put out 50 million tonne.
Liontown's not the only one there that is, on the brink of production.
Yeah, so
they're in vastly different, stages of their life.
Totally, and the other big issue, as opposed to the fact that it's just a matter of you needing to add on the unfunded CapEx that is to come. The other issue there, right, it comes from the time value of money. If the timeline to production is far apart between the two companies, the multiple is silly too, because if you just read it just makes no sense. So they're just not comparable things if one's 10 years from production and the other one's producing around the corner. So let's take a look at the companies on this chart. And if you just look at the numbers on face value, the ones that are highlighted there, PMET's cheap, only 0.3k EV per LCE tonne versus peers with higher multiples. There's upside, right?
I mean, some of them are producing this year.
Yeah, yeah. So
Sigma for one.
Let's look at those peers, right? Liontown, first production expected mid-2024, claimed to be fully funded. Sigma producing 130,000 tonnes this year. AVZ, let's just get it off the list, come on.
Piedmont, they're going to be producing
56,000 tonnes this year, and they're going to be more of a chemicals business anyway. Get it off the list. Sayona, supposedly producing 170,000 tonnes this year, and fully funded. Core producing concentrate already, guiding towards 95,000 tonnes next financial year. These are not like for like peers. They're funded. The capex and infrastructure is either sunk or committed. They are producing now or next year. So my message is pretty simple. Let's be sensible when forming an argument based on relative valuation. use comparable peers. I get it's a small universe, but come on.
Trav, you've also been tagged in you're the associated Twitter handle with PMET, it appears. You're getting tagged by everyone this morning, which is good for info as well, because everyone starts sending through stuff. Would you like to go through a bit? Would you like to share your little Twitter feed with everyone?
Yeah, it's some funny stuff out there I got tagged in. Maverick says, nice tonnage grade, but looks like a terrible strip ratio due to the steeply dipping pegmatites and higher grades deep in pit. No wonder they refuse to show cross-sections. Chucky says, looks like a very expensive option on lithium a decade or so down the track. Buy low, sell high says, yep, it was the helicopter photo making investors sell. And I also saw one more. This is the counter argument, I think, to what you're going to put forward, Matty. YYC says, looks pretty good to me, not high strip at all. In the Nova zone, you can support much higher average strip. If a blob 100 metres thick at surface can't be mined cheaply, then nothing can. Trolls running out of things to whinge about. Now they even release cross sections.
And the other one, there's a good one.
Oh yeah,
we can't leave this.
This is
one
a
out.
great one. Yeah, so we got at Chubb Money of Mine. The PMT MRE is out, and there are some cross sections for you to have a wank at.
I can probably put me bottom dollar on it that Travis not going to masturbate over these cross sections.
Fan of the pod.
Good stuff, boys. Right, let's get into, and you would have seen in that tweet before, the thing about the mineral resource, there is that depicted high grade Nova zone, where the juicy stuff is the honeypot. It's because this mineral resource, it's been reported as like one whole resource over a big long strike, but there is there is some cross sections of the pegmatite ore body. Not saying which all of that pegmatite is mineralised, but there is two cross sections that actually show the grade distribution. So, and that was where one of those sort of tweets went into. So, look, I'll go over that. I guess what info I'd be looking for in future updates and where this is heading from where it is today. So, JD, you want to add anything before I get stuck in?
Go for it, mate.
Go for it.
Dig in.
So, look, as you mentioned, JD, the resource is 100% inferred at this stage. And as I said, it's not uncommon for the Maiden mineral resource to be fully inferred.
And for those wondering, that just means it's with less geological confidence than a indicated or a measured resource.
Yeah. And they said their most drill hole collar spacings along the exploration strike are at 100 metres apart. Some areas they are at 50. So if you're in that 50 to 100 metres, it is inferred. To get inferred is about 40 to 50, so even 100's a bit. But this is a bulk deposit as well.
Yeah, it depends on the deposit type.
It's not like a nuggety gold deposit, so it does vary on commodity to commodity and the ore body style, what is deemed inferred and indicated. So, but that's definitely an inferred spacing. So they do announce that they've got 30,000 metres of drilling planned coming up, and to infill this CV5. So you would anticipate that is going to put some of that inferred material into the indicated category, which is the higher confidence level. So, and that's what you need. You need it for the confidence. So look, the recent mineral resource upgrade that Latin Resources put out, so it was 45 million tonne at 1.32%. 66% of that was in the measured and indicated category. So that's a higher confidence ore body. This is their only first one. So because this is an NI43 resource, so that's the Canadian JORC version. Not 100% sure, because I know the CP, the competent person, is JORC. Like, this was released under a JORC, under the JORC compliance for the ASX listing rules. They put the table in, but I'm not 100% sure if it's a JORC compliant resource.
They call it compliant with 2012.
Yeah. So as part of that NI43 process, which is not a JORC requirement, the NI43, they have to submit a technical report within 45 days of releasing this resource. So that technical report gets released to, what is it, CEDA? Yeah, CEDA. So that would give a lot more detail than what's in the announcement. The info I got from my geology friends that NI 43 is a lot more of a prescriptive process. There's a lot more information that has to go in, but it's not as detailed and in the weeds as a JORC resource. So they're sort of the differences. That was the main difference between them. And NI 43 competent persons, they're called qualified persons. They have to jump through a lot more hoops to get registered to be a QP, whereas not as many as a JORC. So it's a bit more rigorous paperwork process, very much more prescriptive to get an NI 43. So looking at the grade distribution, these were the two cross sections they put up, and I guess the key one to look at is the one that's in this high grade Nova zone. So you can see it here. So this high grade Nova zone looks to be about, based on the scale, about 150 metres below the surface, and that's what one of those tweets was referring to. One was saying high strip ratio, the other was saying, look, there's ore at the top there. If you can't mine that and not make money, it's not worth it. So it's just, I guess, something to consider when you take the first look at that. You've got to wait a long time to get to that high grade ore. So
it sort of bodes in with what Trav was saying earlier, right? There's, that pile of cash is a bit deeper in the ground, which means it's a bit further away time-wise, which just sort of, you chuck in the model and see the cash flows are weighted a bit more to the back end as opposed to the front end. And
it's one of those things, whenever you see vertically dipping or close to vertical dipping ore bodies, we've seen it with Essential, we've seen it with Global Lithium, they do have very high strip ratios. And then you also see when the high grade or the honeypot is at the lower end of the pit, it's a back end weighted mining schedule.
And when you see them, Matty, you just think underground mining.
Underground mining, oh God, we'll get into that. Well, that mightn't be a good idea. So yeah, they quote a 6-to-1 stripping ratio in the announcement. So there's 6-to-1 waste to mineral resource in it, what they've quoted. But if you look at the resource they've put out, this 1.42%, but then you look at where that high grade area is, so that's 2 to 3% above. So I'll be looking for more info from either this technical report or follow-up documents to say, right, how much of this high-grade Nova zone is contained at that 150 metres below? How much of the resource is there? So rule of thumb that I've got off some open pit people. So say that's 150 metres. If you're doing an open pit, you can, from a scheduling point of view, you can sink a pit at about 8 benches per year, just to, there's plus or minus, varies, but it's a good sort of thumb suck. And a bench can be 10 metres high. So that's the super pit has 10 metre benches. Wodgina a few years ago, to my knowledge, had 10 metre benches. If you go bigger...
And a bench, for those wondering, is those sort of layers you see. And imagine you've got an open pit. Those various layers are called benches.
Yeah, so 45-degree pit angle, and they come in at bloody like a little staircase is the best way to explain it. So looking at that, look, you can get massive gear to do it and get down quicker, do bigger benches, but massive gear, more capital, and not as... you can't be as surgical when you're mining thinner loads, but this is a bigger load, so it should be, you could use bigger gear. So look, as I said, thumb suck, 8 benches at 10 metre benches. It might take you up to 2 years to actually get down to that 150 metre high grade zone. As you said, Trav, we could work on potentially 10 years or something just to actually get to production, and to actually get mining. Then you delay that high grade zone for another couple of years, where the actual honeypot of the cash flow comes in. So
yeah, it's not to say they can't have it humming a lot earlier than that. It's just to highlight the risks in permitting, dragging things out longer than maybe people have in their base case, and just wondering, does a $2.5 billion fully diluted market cap sort of support? Does it support the optimistic case, or does it, and is it durable when you plug in a more prolonged base case?
Yeah, and I'll just look forward to a bit more grade distribution to see where all this is sitting. There is the option to go underground to access that stuff quicker, but let's look at the success of Northern Star, Evolution, Silver Lake. Silver Lake have just put Sugar Zone into care and maintenance today, which we'll go into later. They're Australian underground mining specialists, and they haven't been able to make it a smooth process over there. So, yeah, going underground's not a quick fix. So
It wouldn't just be underground, Matt. It'd be underwater.
yeah, technically, oh, good. Imagine bloody ice coming through the rock and getting you. So I'll be interested to see what's contained in this technical report that gets submitted to CEDA, if there's like more detailed cross-sections of where this actual grade's sitting. Because looking at pegmatite interps you need to know where the grade is. So there we go.
Very good.
Go Patriot.
We hit a couple other quarterlies.
Emerald. They're like another little elusive child of the mining industry, aren't they? Definitely a very rich child.
Golden child.
They are quiet performers, I think. So they came out with a quarterly, and they actually announced the purchase of Bullseye late last week. So Bullseye is a public unlisted company, something we're somewhat familiar with now. So they've got the North Laverton project, and it's been predominantly Chinese owned for a while. But coming into this, Emerald did own 60%, so they tried to actually take it over a couple of years back. So the acquisition is an all-scrip deal, and the big kicker here is Emerald, which have done such a good job developing and ramping up and now producing from their Cambodian asset, they're now going to have an asset in Western Australia.
They'll have the full control of it, right?
Yeah, they'll have full control.
Had 60%, and now they get 100%.
So I think that's pretty huge, and again, it just sort of flies under the radar because Emerald in general fly under the radar. They're not flashy promoters, and as well as that, the company they're acquiring hasn't been publicly listed. So really interested to see where this sort of progresses from here. It's kind of hard to find out information on the acquisition, but going off a 2015 resource that came out for that North Laverton project, things were grading about 2.5 grams per tonne, and they're about halfway through a 98-kilometre resource definition drill program. So I'm quite excited to see a bit more info come out and see how that Bullseye project really shapes up in the hands of Emerald.
If it was 2015, it was probably a cut-off grade that's a bit outdated now as well. So
yeah. Somewhat.
Yeah.
So they've got plenty of drill results out. You can go and see, ranging between 1 gram per tonne and up to 9 grams per tonne over various sort of interval lengths and stuff. But yeah, it's quite exciting. And a key component of the deal is all the ongoing lawsuits being dropped, and there was quite a few of them as well.
Yeah, for a price tag.
I think the cutoff grades you used back then are now the head grades in this market. So, right, VALE boys.
VALE, this one is super interesting. So VALE split out their business into two. They've got their core iron ore business, and then they've got their various base metals business. And the base metals business had a valuation of roughly $30 billion US internally. So they've sold 13% of that base metals unit off. 10% has gone to a Saudi Arabian JV. The JV is between Saudi Arabian Mining, which is also known as Maiden, as well as the country's sovereign wealth fund. So they bought 10%, and the remaining 3% was purchased by this US investment firm called Engine Number One. So we won't go too much into this because it's quarterly season. There's lots of other things to talk about, but I just find the macro sort of context fascinating. This is like, we've really started to see over the past couple of years these Middle Eastern sovereign wealth funds starting to invest outside of the traditional, playgrounds of fossil fuel assets, which they've built their countries on, really. And those sovereign wealth funds are ginormous. So the scale into which they could invest in the mining sector is really large, and I'm just fascinated to see how deep they go into that.
Have you looked into the one in Denmark?
I think the Norway one might be the one you're thinking of.
Oh, is it Norway?
Yeah. It has something like $200,000 or $300,000 per capita, so per person. Yeah. Because it's only a country of 4 odd million or something.
And I think it owns double-digit percentage of all the equities in Europe, from memory.
It's insane. All from the northern oil and gas.
God, lucky I got you boys here to correct me. But then the argument was, when I heard it presented, it's like, why doesn't Australia have one of them with all the natural resources, royalties? Why hasn't there been a sovereign wealth fund developed for Australia?
Yeah, that is a whole nother debate.
I mean, we can talk about the future fund in the context of sort of being a bit of a sovereign wealth fund. So,
and it was set up on the back of inspiration from Norway as well.
Yeah. But it's fascinating, JD. I think this, Saudi Arabia. I read something pretty funny the other day that Mbappe, the footballer, rejected being made a billionaire because he didn't want to hang out in Saudi Arabia for a year. So anyway, it just goes to show how much money these guys have.
In the prime of his career.
You can't drink there, can you?
He's one of very few players that have said no. So
lots of money diversifying into footballers and mining now.
Yeah, that's it. Let's get into Silver Lake.
Oh, geez, hammered down a bit under 20%. They were down 18% last time I looked.
Yeah, so this is an interesting one for a couple of reasons. Firstly, they'd pre-reported the quarterly, so investors had sort of got comfortable that there was going to be no surprises. And then the quarterly comes out today, and lo and behold, there are a few surprises. So the top line is record quarterly production, 81.6 thousand ounces for the quarter. But don't let that fool you. I think the trick with this one, like many of them, is to read it in reverse, and then you're pretty quickly cotton on to what's actually important. So FY23 production was for 261,000 ounces at an all-in sustaining cost just below $2,000, to give a bit of context. So here's the kicker. Guidance for the next year will be 220,000 ounces at a similar all-in sustaining cost, going off the midpoint of guidance. Now, this largely comes as a result of Sugar Zone, the troubled Canadian asset that they have, being switched off. Matty, you had a read of this as well. It takes 2 or 3 reads to understand what they've actually done.
It did take a while. I'll read the whole thing at the start, and I'll just figure, bear with me. So, consistent with Silver Lake's proven margin over short-term ounces strategy, activities at Sugar Zone will pivot to an investment in drill data acquisition in parallel with an idling of mining and processing activities to facilitate a reset of mining practices and upgrading of site logistics network necessary to support a higher margin and long life operation.
So if they were trying to confuse me, they did a pretty good job.
They're putting it in care and maintenance.
100%.
We should do a quarterly translation for this one, Matty.
Yeah, they're putting it in bloody care and maintenance. So that's, yeah. And look, it might be one of those cases, I did see a broker comment, which is true, might be a 1 step back, 2 step forward situation if they do this, get more handle on the ore body. And I think when they're talking about facilitate a reset of mining practices, so whether that's sort of bringing the North American mining
up to scratch
practices in line with what we do in Australia. So whether it's bulk meshing with jumbos, I'm not sure what they mean there. But look, it might be, it's a kick in the balls for them at the moment.
Yeah, and it's obviously a big shock for the market, hence the stock's off 20%. So I think it's important with all these things, just like we touched on with Patriot, to always assess them versus what the expectations were, because that's how they trade.
Because they in that comment below, JD, they also put talking about they're going to move the camp and everything like that. The market it's not forgiving. The market wants to know how much fucking gold's coming out, what's it going to cost, and we don't care where people are sleeping. And so they've looked at the guidance and it's being switched off. It's like, right, down 20%.
Agreed.
They're ruthless people, these investors.
So looking at what some of the brokers had forecast for next year versus that 220,000 ounces that they've now guided to, Euros had 285, Argonaut had 300 roughly, and Canaccord had also roughly 300,000 ounces. And all of those brokers had slightly lower all-in sustaining costs versus what the guidance has come out at as well. So obviously it would have been hard for a lot of those guys to predict that the company was going to put Sugar Zone on care and maintenance. And hence you see, the stock dropping quite a bit. And to your point, Matty, Sugar Zone hasn't performed. So you're dead right. It could be 1 step back, 2 steps forward. It could be the right choice in the medium to long term. But in the near term, the company's going to put $35 million into the ground. 28 million of that is exploration, and the remainder is to put in 3 development drives to really drill this thing.
Exploration drives, yeah.
Exactly, to really just drill the thing out, get a really sound understanding of what's going on so they can turn it into a profitable production.
And I reckon you got to give credit to companies that have put the foot forward and say, no, we're turning this off because it's not making money in its current state. So putting the capital in to explore it better and for potential upside later on. If it's not making money, why keep going? So it's a good move if that's the case, and they're going to understand the ore body better and potentially find further bits of the ore body that they don't know are there yet.
So it's a bit of a bitter pill for investors to swallow. But unlike other companies that have had to make such a call, these guys have $332 million in cash. They don't have to recapitalize the business or anything. So it could actually present an opportunity for investors out there. Everything's got a price, and the stock's, when I last looked, was off 22%. So that caps the company at 810. Given the cash and gold position, that's an EV of $480 million for a company that's going to spit out over 200,000 ounces over the next year. So, like we sort of touched on, Sugar Zone might just need that reset and become a profitable asset in the future. And it, could demonstrate management having a bit of a longer term view. So, okay, should we touch on Strandline? We gave them a little mention on their capital raise late last week.
Yeah, mate, we could have talked about IGO, we could have talked about Linus, and instead you bloody talk about mineral sands. There were way sexier things we could have talked about.
You pointed out Strandline, that's why I'm speaking about them. And amongst the 850 announcements today, I think IGO were just a bit too slow. So Strandline, we're going to touch on, and we're going to give a bit of an overview about what they're actually doing, because I think a lot of people find mineral sands kind of confusing. So they raised $30 million late last week at 18 cents, and they last traded at 22 cents. So that clearly indicates that ramp up isn't going perfectly there. So the company first shipped heavy mineral concentrate, or HMC, in November of last year. And this sort of contains things like zircon, ilmenite, and rutile. They use a wet concentrate plant to produce this HMC. And I mean, one of the key problems that they're having is that this concentrate plant isn't running at nameplate capacity. So they've said it has, but not consistently running at nameplate. So that's one of the real issues they're having. They're also commissioning the mineral separation plant, which is, it's in the process of ramping up, but they decided to produce this HMC in the near term and sell it to Chinese buyers so that they could get a bit of cash in the door and just help see them through that ramp up period.
Get a higher price for the separated product, but you got to build the plant. Yeah.
Geez, you're much the wiser on mineral sands today, JD. I'm bloody impressed, Cobber.
I am, mate. So with all that said, they're going to be producing these things. They've already started to stockpile the ilmenite. They're going to be producing a zircon concentrate, a premium zircon product as well, and lastly, rutile. And the last thing to sort of think about with this mineral sands project is it's a big sort of open pit mining void that's left once they kind of run through it. So they progressively backfill with sand tailings just over the life of the project. And it has a long, the initial mine life is, I think, 22 and a half years. That said, the capital raise, things aren't quite going too well. So that's on the back of elevated costs and some delays that they've been having. So the company pointed at lower availability of dozer mining units, the mining plant and equipment, as well as relating to that tailings disposal. They're having issues. Essentially, what they're putting back in is taking up more volume than anticipated, and that just slows the whole operation down. And on top of that, there have been mineral sands projects in the country before that have had big problems on this matter. So I think it's something that's kind of scaring investors, and hence we've seen the share price steadily fall from 50 odd cents to where they're raising money at.
Reminds me of core lithium as well. A different commodity, obviously, but it was the volume of their the fines that they had to go and take back as.
Yeah, that's an interesting analogy I hadn't quite thought of. There's one other issue that sort of came to the fore. They signalled that their 7th shipment had, it had slightly lower volume than the previous shipment. So they've been ramping up, getting greater and greater shipments, and that was just something, of note to investors. So the company, speaking of expansion, they want to add 15 years of mine life, and they've also got this Tanzanian asset, which the hopes of the company were previously pinned on before the investment prospects in that country went down the drain, 5 or so years ago. And there's one other thing that's really of note that always stands out, and we made a bit of a joke about it in the videos we uploaded last week. The MD and CEO resigned late last week. He resigned as CEO, so he's actually still staying on as managing director. And to be fair to them, they've done a great job in building the plant on time and on budget. Mm-hmm. But, that's a huge red flag to me when somebody in the key leadership steps down as CEO during ramp up.
Yeah.
So that's my research on
Good
mineral
work,
resources.
JD. Bloody pat on the back, Connor.
I like it. There's bulks is a doing bulk operations. It's all about efficiency, logistics, and everything like that. And reading this, it's the volume of what they've got to backfill. That's an efficiency thing, right? It's
absolutely.
Yeah. tricky one.
Good work, boys. Right, one episode less before Diggers. Oh, God, I'm bloody excited. Thanks, as always, to the friends of the show, our best friends of the show, Anytime Exploration and Terra Capital. Thanks for all the support, guys, and cheers, Money Miners. Let's schedule in a g'day at Diggers. Can't wait to meet you all. Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.